We want to distinguish the single rate method from the dual rate method. We want to understand how the choice between allocation based on budgeted and actual rates and between budgeted and actual usage can affect the incentives of division managers. We want to allocate supporting or multiple supporting departmental costs using the direct method, the step-down method, and the incremental method. We also want to understand how to allocate common costs using the standalone method and the incremental method. We want to explain the importance of explicit agreement between contracting parties when the reimbursement amount is based on cost incurred, and we want to understand how bundling of products causes revenue allocation issues and the methods managers use to allocate revenues. So how a company allocates its overhead and internal support costs, those are costs related to marketing, advertising, and other internal services, among its various production departments or projects can have a big impact on how profitable those departments or projects are, and in turn can impact those department or project managers' bonuses and incentive compensation. Operating or the production department directly adds value to a product or service. Support or service department provides the service that assists other internal departments, that is, other operating departments or support departments in the company. So we think about support or service departments, we're thinking about accounting or human resources or legal. So these departments provide services that assist other departments, such as the operating department. And then the question becomes one of, well, how do we account for the cost associated with these support departments, given that the operating department costs are generally considered direct costs? If you remember the distinction between direct and indirect costs that we talked about earlier in the semester. Managers face two questions when allocating the cost of a support department to operating departments or divisions. So first, should the fixed cost of a support departments be allocated to operating divisions? And if fixed costs are allocated, should variable and fixed costs of the support department be allocated in the same way? With regard to the first questions, most companies believe that the fixed cost of support departments should be allocated because the support departments need to incur these fixed costs to provide the operating divisions with the services they require. So there are two methods to allocate support department costs. The first one is the single rate method, which does not distinguish between fixed and variable costs. It allocates costs in each cost pool using the same rate per unit of a single allocation base. A support department would be an example of a cost pool. And so perhaps the human resource department would be a example of a cost pool. So all of the cost associated with providing the human resource service to the operating department would be accumulated in a pool and then allocated out over some base that reflected some causal relationship with the pool of costs. The dual rate method partitions the cost of each support department into two pools, a variable cost pool and a fixed cost pool, and then it allocates each pool using a different cost allocation base. And so if we think about our human resource department example earlier, perhaps we would have a fixed cost associated with the facilities that human resources is housed in. So that's the fixed cost portion of the cost pool. And then we might think about the number of staff in the human resources department. That one could think of in variable terms, in the sense that, you know, the more staff we have in general, or the more employees we have in general, the more HR staff to support those employees we need. So there's some variable component of that element. And so under either method, allocation of support costs can be based on one of the three following scenarios: the budgeted overhead rate and budgeted hours, the budgeted overhead rate and actual hours, or the actual overhead rate and actual hours. So when using either method, managers can allocate support department costs to operating divisions based on either a budgeted rate or the eventual actual rate. The latter approach is neither preferred nor widely used, and we'll talk about using budgeted rates. So the advantages and disadvantages of the single rate method. So the first advantage is that it's less costly to implement. The second advantage is that it offers user departments some operational control over the charges they bear. And then a disadvantage is that it may lead to operating department managers making suboptimal decisions that are in their own best interest, but may be inefficient for the organization as a whole. And a good example of this would be that, well, perhaps a manager believes that they can duplicate the effort that the service department is providing in their division, and another manager sees that that may be happening, so they decide they can duplicate the effort, and then pretty soon you have a service department servicing multiple operating divisions, and some of those operating divisions having duplicated that function within their own division, and so we have a higher cost in total. If we look at the dual rate method, one advantage is that it guides department managers to make decisions that benefit both the organization as a whole and each department. And a second advantage is that allocating fixed costs based on budgeted usage helps user departments with both short-run and long-run planning, because user departments know the cost allocated to them in advance. There are some disadvantages to the dual rate method as well, which include the requirement that managers distinguish variable costs from fixed costs, which is often a challenging task. Another disadvantage is that the dual rate method does not indicate to operating managers the cost of fixed support department resources used, because fixed costs are allocated to operating departments based on budgeted rather than actual use. And then finally, a disadvantage is that allocating fixed costs on the basis of budgeted long-run usage may tempt some managers to underestimate their planned usage. So we can use three methods to allocate support costs to production cost: the direct method, the step-down method, and the reciprocal method. The direct method allocates support department costs directly to operating departments. That is, no other support departments are allocated other support department costs. So for instance, under the direct method, IT cost in an IT service center would be allocated to operating divisions, but even though the accounting department and perhaps the human resources department and perhaps the legal department would use IT support, they would not be allocated any support department cost. The step-down method partially allocates support department costs to other support department, and then the reciprocal method fully allocates support department costs to other support departments. So we have just the theme here of no allocation from one support department to another, all the way up to, or the range all the way up to fully allocating such costs. And so the direct method allocates support costs only to operating departments. The direct method does not allocate support department costs to other support department, and that's the example. So if we are using the direct method and we have an IT support unit, an HR support unit, an accounting support unit, the IT cost would not be allocated to accounting or HR regardless of the usage. The human resource department cost would not be allocated to IT or accounting regardless of usage, and the same is true of accounting. All of those department costs would be allocated only to the operating departments. And so here we just see an example of the cost for the support and operating departments from a sample company. We'll use this information to allocate the cost using the direct method. And so here we see that the engineering and production has budgeted overhead costs before any interdepartment cost of $300,000. And that is a support department, and the materials management support department has a budgeted overhead cost of $264,000. And then we see our operating departments of machining, assembly, and a total. And each of those have their budgeted engineering activities, they have budgeted material handling and labor costs. So in the direct allocation method, we would simply allocate from the support departments, that is the engineering and production and control goes only to machining and assembly, and the materials management goes only to machining and assembly. You see no lines between engineering and production control and materials management. And so based on this allocation methodology, we can see that we've allocated out, that if you look on row 8 for support departments, you can see that we've allocated out the totality of the engineering and production control and material management costs, because those are 0. And you can see how we've allocated each of those support departments into the machining and assembling departments. The step-down method, which is also called the sequential allocation method, allocates support department costs to other departments, other support departments, and to operating departments in a sequential manner that partially recognizes the mutual services provided among all service departments. So let's look at an illustration of that. So here's an illustration of how allocations will occur using the step-down method. And so you can see that we allocate the engineering and production control, and we can see from this illustration that part of those costs are going to material management, which is another support department, and a part of them are going to the operating departments and the assembly departments. And then we see that the material management is allocating its cost out, including the $90,000 from engineering, production, and control, and that those are being allocated out in addition to the materials and management department cost to the operating departments and the assembly departments. I'm sorry, the machining department and assembly department. What we don't see is a line back from materials management to the engineering and production control. That is, we don't see it going back up in the other direction. So the basis change here, since we include other support departments as well as the operating departments to obtain the allocation rates. In this process, the engineering department is allocated to other support department first, then that revised total is allocated to the operating departments. So again, we see that the support departments are fully allocated out. There are no, on line 9, there are no operating costs left in the support department, and those support department costs are allocated out from engineering and production to materials management to machining and assembly, and then a new total in materials management is allocated out to machining and assembly. And then we get to our third method, the reciprocal method, which allocates support department costs to operating departments by fully recognizing the mutual services provided among all support departments. The reciprocal method fully incorporates interdepartmental relationships into the support department cost allocation method, and it's also known as the matrix method. And so we hear that this is a much more complicated allocation methodology, and we can see from our simple spreadsheet here that this becomes an iterative process whereby multiple iterations are repeated in order to get cost allocated out completely. But at the end of the day, as we see on line 16, the service departments, engineering and production control and materials management, are allocated out completely to 0 to the machining and assembly. However, what we also see here is that engineering and production and control is now receiving some portion or some allocation from materials management as well. So between support departments, we see a two-way allocation of cost between the support departments and into the operating departments. So the reciprocal method fully incorporates interdepartmental relationships into the support department cost allocations. First, engineering and production control costs, a support department, are allocated to all other departments, including the other support department. The cost in the next support department, materials management, is then allocated to all other departments, including engineering and production control. Those costs that had been 0 now must again be allocated to other departments. Successive rounds of allocation result in smaller and smaller amounts being allocated and reallocated. The reciprocal method can also be implemented by formulating and solving linear equations, which requires 3 steps: to express support department costs and reciprocal relationships in the form of linear equations, solve the set of linear equations to obtain the completed reciprocal cost of each support department, and then allocate the completed reciprocal cost of each support department to all other departments on the basis of the usage percentages. So now let's look at an overview of the three methods that we just discussed. Differences among the three allocation methods, or three methods of allocating, increase as the magnitude of the reciprocal allocations increases and as the differences across operating departments' usage of each support department services increases. Reciprocal is conceptually the most precise because it considers the mutual services provided among all support departments. Direct and step-down are simple to compute and understand. The direct method is widely used, but as computing power to perform repeated iterations increases, more companies find the reciprocal method easier to implement. And so let's discuss allocating common cost. And we define a common cost as a cost of operating a facility, activity, or like cost objective that is shared by two or more users. These common costs arise because each user obtains a lower cost by sharing than the separate cost that would have resulted if each user operated independently. The goal, of course, is to allocate common costs to each user in a reasonable way. So we have a couple of different methods of allocating common costs, of course, the first one being the standalone cost allocation method. This method determines the weights for each cost allocation by considering each user of the cost objective as a separate entity to determine the cost allocation weights. Individual costs are added together and allocation percentages are calculated from the whole and applied to the common cost. The second way, the incremental cost allocation method, ranks the individual users of a cost objective in the order of users most responsible for a common cost and then uses this ranking to allocate the cost among the users. The first ranked user is the primary user and is allocated cost up to the cost as a standalone user. They typically get the highest allocation of the common cost. The second ranked user is the first incremental user and is allocated the additional cost that arises from two users rather than one. Subsequent users are handled in the same manner as the second ranked user. And of course, these different cost allocations become particularly relevant to government contractors. And because there is some subjectivity, a lot of decision-making goes into the cost allocation methodology. Sometimes there's judgment involved. And under federal contract law, we can end up with contract disputes as a result of this. And so the U.S. government reimburses most contractors in either of two ways. The contractor is paid a set price without analysis of contract cost data, which we refer to as a fixed price contract, or the contractor is paid after an analysis of actual contract cost data. In some cases, the contract will state that the reimbursement amount is based on actual allowable costs plus a fee. This is sometimes referred to as cost plus contracts, but technically the difference being that one is, the example one here is a fixed price contract. Example two is referred to in contracting circles as a flexibly priced contract. That is, it's flexible, the ultimate price being flexible because it's based on actual direct and indirect cost. And so we can understand then from this how this idea of the judgment and discretion that goes into how we allocate could impact the price the government pays. And in the case that they don't agree, the contract allows for disputes. So allocation issues can arise when revenues from multiple products are bundled together and sold at a single price. The methods for revenue allocation parallel those described for common cost allocations. Revenues are inflows of assets companies receive for products or services provided for customers. Revenue allocation occurs when revenues are related to a particular revenue object but cannot be traced to it in an economically feasible or cost-effective way. Bundled products and revenue allocation methods involve a revenue object, which is anything for which a separate measurement of revenue is desired, and a bundled product, which is a package of two or more products or services that is sold for a single price, but whose individual components may be sold as separate items at their own standalone price. And so we use two methods to allocate revenue to bundled products. The first is the standalone method. Under the standalone or separate revenue allocation method uses product-specific information on the products in the bundle as weights for allocating the bundled revenues to the individual products. Three types of weights may be used: selling price, unit cost, or physical weights, or physical units. The second is the incremental revenue allocation method. Under the incremental revenue allocation method, we rank individual products in a bundle according to criteria developed by management and then use this ranking to allocate bundled revenue to individual products. This is similar to an earlier discussed incremental cost allocation methodology, whereby the first ranked product is the primary product, the second ranked product is the first incremental product, the third ranked product is the second incremental product, and so on. And so this concludes our discussion of Chapter 15, where we talked about the allocation of service department costs, common costs, and revenues. Please don't hesitate to bring any questions or comments to the attention of your course facilitator, and please go back and read Chapter 15 to get a good understanding of the concepts we talked about. They're important and somewhat abstract concepts, and so don't feel free to go back and read the chapter again, but by all means do not allow this discussion to take the place of that. And I look forward to talking with you again soon. Thank you.